Hello, beautiful people. Welcome to another brand new episode of the ITU Forex class. In this week's episode, we're actually going to be talking about a topic which is very, very important. And this is one of the foundations you would need to understand in and out for you to become a consistently profitable Forex trader. In fact, this doesn't only apply to Forex trading, it applies to trading the financial markets in general, regardless of what market you're trading, whether it's crypto, whether it's the stock markets, whether it's Forex, whatever it is. Understand, having a very good grasp of the topic which we're going to be talking today is going to be a cornerstone of the things you're going to need in order to become a consistently profitable Forex trader in general. Okay. And what is that topic exactly? That topic or that subject matter is trading psychology. Okay. And for those of you who have been around the trading space for some time, you must have probably heard professional traders telling you that trading psychology is about 70% of the three things you need. Excuse me. It takes up about 70% of the things you need, the three things you need to become a consistently profitable trader. Okay? So, what about the other two things? What are they? Well, contrary to what most inexperienced traders believe, trading strategy, which is one of the three things, is actually it only takes up about 10% of what you need to be a consistently profitable trader. And the other 20% is going to another important subject matter, but it's not as important as trading psychology, because you could have the best trading strategy in the world, you could have your risk management on point, but if you don't have your mind right, meaning if you take a couple of losses and all of a sudden you're not taking signals from your trading strategy, or you're not placing the trades that your trading strategy is signaling to you because you're scared of taking a loss, or you're over risking, or whatever the case might be, because you want to double down and double your account and all of that, then all of those other things would just not make sense. And so risk management is the thing that makes up the other 20%. So 10% is your trading strategy, 20% your risk management, and the topic which we are going to be talking about today, making up about 70% of the three things you need to become a consistently profitable trader, is trading psychology. So in a nutshell, what is trading psychology? Okay, put simply, trading psychology is just the way you think about trading, or the way emotions affect your trading decisions. Okay, so let me give you an example. You see, let's say you take a trade, for example, okay? And then after taking that trade, you have your stop loss, you have your trade entry, you have your profit target, and all of those things. But then the trade just hits your stop loss. And let's assume that the trade you took, you didn't just take a random trade. You took a trade based on a trading strategy that's been tested and proven to work. So you've got the data that tells you that over the last 100 trades that this strategy was taken on a particular account, for example, maybe through a simulation account or a demo account, or whatever the case might be, doesn't really matter. Okay, over the last 100 trades that were taken, 50 of them, or let's make it a little realistic. Let's say 46 of those trades were winning trades, while the remaining 54 trades were losing trades. But the trader still managed to become profitable, even though his win rate was much lower than 50%, for example, which is an average win rate, okay? Because his risk management and trading psychology for the environment he was trading in, maybe let's just say this was a simulation trading environment, he still managed to make a profit because those two things were on point. So because it was a simulation trading environment, when he took a losing trade, he didn't doubt the next trade setup that got signaled by the trading strategy. So for example, when he took a losing trade and he saw another setup telling him to take another trade, he didn't start saying, you know what, my last trade was a losing trade, and so I don't quite trust this trading strategy, I'm just going to skip this trade. No, he took the next trade. And let's even say the next trade was also a losing trade, and the one after that, and the one after that, until he had something like 10 losing trades in a row. He still kept to the plan. Even though he took 10 losses in a row, when he saw the signal for taking the 11th trade, he took it. Okay? Not because he wasn't scared or anything, no, but because he knows that the profitability or the edge of his trading strategy is only going to work in his favor when he becomes pretty much emotionless. And so whenever he sees a signal, regardless of the outcome of the previous trades he took, he would still stick to the rules and take that trade. Okay? And this could also be the flip side. What do I mean by this could also be the flip side? This could be that he took the last 10 trades, and the outcome of the last 10 trades that he took were all winning trades. Because just like you can have losing streaks, you can also have winning streaks. Okay? And so just imagine for a moment here, okay, that you were in his shoes. You've tested a trading strategy and it's proven to be profitable and all of that. And then you took a trade with it, and then it was a winning trade. And you're excited. Because let's say, for example, you're risking 1% of your account's capital, because this is what professional traders advise us to do, recommend we should do. And you're risking that 1%, aiming for a profit of 2%. You're trading with a simple strategy that had a 1:2 risk to reward ratio. Okay? So whenever you're risking $1, you're aiming to make $2. Or whenever you're risking 1% of your trading account's capital, you're aiming to make 2%. Now, let's say the first trade you took was a winning trade. And the one after that, and the one after that, and all the way to like the 5th or 6th trade. By now, most traders who are inexperienced in trading the markets will start to feel invincible. They'll start to think that this profits that they're making is not because of anything, it's because their trading strategy is just the best thing since sliced bread. And so, most of the times, instead of them sticking to the plan, risking no more, keeping their risk consistent, meaning they're not risking no more than 1% of the trading account's capital on each trade they take, because they've seen that they've taken win after win after win, they're now starting to feel invincible. And most of the times, the trap that most inexperienced traders will fall into is that they'll start thinking that that trading strategy, is the best thing since sliced bread. And so they're not going to take any losses. And so, instead of continuing to risk 1% of their trading account's capital on each trade they take, they would start getting greedy. All those voices in their head telling them how they could just double or quadruple or triple their accounts, by just upping their risk a little bit, since the trading strategy appears to not be losing any trades, will start getting a hold of them. And so instead of continuing to risk that 1% per trade, knowing that just like they're experiencing winning streaks, losses can be just right around the corner, they would now start giving into their greed. And so maybe they would start upping their risk to something like 5% per trade. And so, remember this example, this is like the 6th trade they took, which consecutively were all winning trades. And so when they risk 5%, aiming for a 1:2 risk to reward ratio, and then that trade also turned out to be a winning trade, that will only reinforce bad behavior, because now they feel they've broken their rules and they got paid for it and they're happy. And so the problem with that is it reinforces bad behavior, because instead of continuing to risk that 1% per trade, now that they've risked 5% and they got a winning trade out of that, they got like 10%, profits. Instead of them, reverting to what they're supposed to do, they'll try to double the account. So most of the times, some traders might go like 10% risk per trade, aiming to make 20% of the account's capital on the next trade. And let's say that even works out. So they risk 10% and they make 20%. Before you know it, they would end up risking something like 50%, aiming for doubling their accounts with one trade. And before you know it, that's always when catastrophe happens, because that's the trade that would end up leading to a blown account. So even though on paper, it will appear that they have a very high win rate and whatever the case might be, because they were not following proper risk and money management rules, and because their psychology was out of whack. Okay, instead of them being disciplined and keeping their risk consistent and doing all of those things and knowing that losses are inevitable in trading, they got out of that mindset and they started risking big when they shouldn't. Okay, so in a nutshell, trading psychology has to do with how you react to the markets based on the outcome of the trades you take. If the last couple of trades you took were winning trades, most of the times traders tend to get overconfident, feeling invincible, and they start, becoming reckless. Okay, and so that is a attitude or an emotion that would quickly get humbled in the market, because as you all know, losses are inevitable in the markets. If you don't have a crystal ball which will tell you for sure, for certain, what will happen in the future on a moment by moment basis, then you are exposing to You're going to be exposed to the risk of the market, and the risk of the market is uncertainty. And so the only way you can protect yourself from that is to practice sound risk and money management. So if you have a trading strategy or a trading system or a trading edge that you've tested, on historical data or on demo accounts or small live accounts or whatever the case might be, and you have data backing it with proof that it actually works, you're most of the times going to see that you're not going to be winning all the trades you take with that particular system, even though it might end up being profitable for you. So, for example, even if let's say you took like 100 trades with it, more often than not, you're going to find that out of those 100 trades you took, some of them will be winning trades and some of them will be losing trades. This is just how the trading game is played. And not only are you going to see some of them being winning trades and some of them being losing trades, but the distribution between your winning and losing trades are going to be random. It's not going to be as if just because this trade was a winning trade, the next one has to be a losing trade, and the one after that has to be a winning trade, alternating like that, on and on and on and on. That's not how trading works. Most of the times, what you're going to find is there are times when you're going to get a win followed by a loss, followed by a win or a loss randomly. And there are times when you're going to get clusters of wins and clusters of losses. The thing is, you need your psychology to be on point so that during those times when you're going to get those clusters of those wins, you're not going to get overconfident and throw your risk management rules out the window. Because when you do that, then whatever edge your trading strategy is going to give you in your advantage is going to be thrown out the window together with your risk management. Because I just explained to you that traders could have win rates upwards of 90%, but still end up blowing their accounts or losing money if they let themselves open up to big risk, taking big risk. Okay? On the flip side, you could also have clusters. It's highly likely that your backtest results or your trading strategies performance metrics is also going to have clusters of losses. And this is what we call winning streaks and losing streaks. Okay, so those clusters of losses are usually what is referred to as losing streaks. Okay, and whether you're trading live, whether you're trading on a demo account, whether you're trading on a simulation account or whatever the case might be, you cannot escape this. There are times when, no matter how good your trading strategy is, there are times when it's going to get clusters of losses. And so what are you expected to do at those type of times? You're supposed to just continue doing what you do. Stick to the rules of the strategy, regardless of the outcome of the past couple of trades. So if the last 5, 6, or 7 trades were all losing trades, when you see the next signal, don't doubt your strategy. Just take the trade with discipline, keeping your risk consistent. Okay? That's just how you do it. So where psychology comes into play is when you have a couple of losses and now you're feeling scared that you don't want to take the next trade. If you have your psychology on point, you're not going to feel that scared because you understand that trading is a numbers game. And at the end of the day, even though you might have 5 or 6 or 7 losses in a row or 10 or even much more than that, if you stick to the rules and stick to the plan and continue following what you're supposed to do, since your trading strategy has an edge over the market, eventually, even if you take more losses than you win, because your strategy is designed properly with good risk to reward ratios, consistent risk management, and all of that, you're going to end up being profitable. That's the hope that we are having. Okay, so this is what the whole crux of today's topics is all about. Okay, so moving on, the thing you really need to understand about all of this is that losses are part of this business. Okay. No, let me give you a short story, okay? When I got involved in trading for the first time, okay, I actually thought, naively of course, that there was some strategy out there. I just needed to find out, and I'm going to find it, that some strategy that is out there that will give me winning trades 100% of the time. And this is not because of any fault on my part. This is just human nature. That's what I learned eventually as I, matured in trading and all of that. Human nature, by default, makes us want to avoid losses as much as we can. Okay, because losses make us feel very uncomfortable, they're painful. Okay, and so when you get involved in the market, you try most of the times, if you don't have the guidance of a mentor who's been in the trenches for some time and all of that, you get that notion of, all I need to do is just keep learning about trading, and when I learn enough of what I can learn out there, then I'm not going to be taking losing trades. And that's just, so you just think that the more you learn, the higher the probability that all of the trades you're going to take are going to be winning trades. But I found out painfully so, the hard way, that you cannot avoid losses no matter what you do in trading. In fact, the time that you're going to get start becoming a profitable trader is the moment you make peace with the fact that you cannot avoid losses in trading. Losses are part and parcel of the business, okay? So every trading strategy, just like I told you moments ago, regardless of what trading strategy you're using, regardless of, all of the returns it made, or all of the golden, beautiful things you're seeing about it, the truth of the matter is it's going to have losses. Some strategies might have more losses than others on average. What do I mean? There are strategies where you'd see that maybe from their backtest results or whatever the case might be, that out of the last 100 trades they took, maybe the win rate was like 70% or 50% or 80%. Some might even be way down in the 30% range, or 35 or 40%. But when you couple those trading strategies with proper risk management and good risk to reward ratios, mostly if you know that your trading strategy has a low win rate, then what is going to compensate for that trading strategy's low win rate is usually going to be a high reward to risk ratio. So if you have a trading strategy that has a 30% win rate, remember, this would mean that when you take 100 trades with that trading strategy, 70 of those trades are all going to be losses, and only 30 of them are going to be winners. So in this situation, you need those 30 winning trades to not only pay for the losses of those 70 losing trades, but also give you extra profits in the process, so that you make that trading strategy profitable. Okay. In a situation like the one I just mentioned, if your trading strategy, okay, has only a 30% win rate, and your risk per trade is 1%, okay? The problem you would find is, let's say your average win, okay, you're trading, let me just say your risk to reward ratio is 1 to 1.5, okay? What I mean by 1 to 1.5 is, when you're risking 1% of your trading account's capital, you're aiming to make a profit of 1.5%. So in this case, let's say after taking number of trades, let's say number of trades, 100 trades, okay? So after taking 100 trades, in this case, 70 of them are going to be losing trades, okay? Number of losses, or let me just say losses, okay? Losing trades. And then your winners are going to be only 30%, okay? 33 trades here. So what is your gross loss? What I mean by your gross loss is, when you add up all of the losses from your losing trades, what is that number? And what is your gross profit when you add up the profits from your winning trades? In this case, your gross loss is going to be 1.5 times 70. Let me quickly pick my calculator somewhere so that we could do this math together. So 70 losing trades times 1.5. That's going to give us a gross loss of 105%. So our gross loss is 105%. Now, what about 70 losing trades times is 1% risk per trade. This is the gross profit that I just calculated. So our gross profit would be, it's not even going to be 105% because we only have 30 wins. So it's going to be 30 winning trades times 1.5, because remember, each one of our winning trades gave us a profit of 1.5%. So our gross profit is going to be plus 45%. Okay? Plus 45%. What about our gross loss? Our gross loss is going to be 70, because we took 70 losing trades times 1%, because every losing trade we took cost us to incur a loss of 70%. So our gross loss is going to be minus 70%. Minus 70%. Now, in this case, what is our net profit? This is the money, our take home, our ROI, net profit. You could call it any of those numbers, okay? Net profit or ROI, Okay. What is that number going to be? Now, in this case, it's actually going to be negative. And the reason for that is because our gross profit is 45%. Now, when you subtract our gross loss from our gross profit, you would end up with a negative of 25%. So if this was a trading account that you were trading that had something like, let's say, $100,000 in it, you're going to be down 25%. You wouldn't make any money. Even because your win rate in this situation, let's say win rate here, win rate was only 30% and your risk to reward ratio was so small. The main thing here I want you to focus on is not the win rate per se. It's not as if it's the win rate that caused you to not be profitable with this trading strategy. What made for this trading strategy to not be profitable with these numbers that we have in this example is simply the fact that the profits from its winning trades were so small that they couldn't cover or make up for the losses from its losing trades and give us extra in the process. Okay? Now, using this same example, let's still maintain everything here. The same win rates, the same strategy, everything. The only thing we're changing here is our risk to reward ratio. And you see the power of risk to reward ratios here, the power of risk management, and how it's going to help you to, have a nonchalant attitude towards trading. Meaning, what I mean by nonchalant is, if you understand that when you manipulate the numbers in your favor, which is exactly what I'm going to show you how to do next, that no matter what the outcome of your trades are, even if you lost the majority of your trades, only won a handful, you're still going to end up being profitable, then you're not going to be afraid of taking losses. And that's where you want to be in trading. That's where you want your psychology to be. Okay, so what would that look like? Now, let me quickly duplicate this if it's possible to do that. Yes, duplicate this. And then what are we changing here? The thing we're changing here is only one thing. Okay, and let me move this to the side a little bit just to make it easy to work with. So let's say our risk to reward ratio is 1 to 5, not 1 to 1.5 like in the earlier example. So in this case, whenever we are risking 1%, we're aiming to make a profit of 5%. So when I pick my calculator again, in this situation, what's going to be our gross loss? Remember, we're risking 1% of our trading account's capital on each trade we take. And our win rate is 30% since we took 100 trades. Okay, so we only won 30 out of those 100 trades that we won. So our gross loss is going to still remain as minus 70%. But what about our gross profit? Our gross profit is going to change because our risk to reward ratio has changed. We're risking 1 to make 5. Okay, so in this case, every single winning trade would have given us a profit of 5%. And we took 30 of those winning trades. So 5 times 30, and our gross profit is now going to be 150%. Okay, so when I type in our gross profit here of plus 150%, okay, now you can see that the number is going to work in our favor, in the sense that when you subtract our gross loss from our gross profit, which is our gross loss here is minus 70%, you'd still end up with a profit of 80%. So in this situation, you would have almost doubled your account, even though you only have a 30% win rate. And why is that so? It's simply because your risk to reward ratio is, your reward to risk, let me put it this way, is very, very high. Okay, excuse me. It's very, very high. So in this case, when you're trading with a trading strategy like this, and let's say you've done your back test, you've seen, you've taken hundreds of trades with the trading strategy on historical data, and firsthand, you've seen that even though the trading strategy has times when it has like 10 losing trades in a row, or, however many losing trades in a row, it still gets a couple of handful of trades sprinkled in between those trades that you take, and it still ends up being very, very profitable at the end of the day. If you have something like this, would you be scared of taking losing trades? Obviously not. But the only thing is, if we're keeping things 100 here, trying to be as realistic as possible, it's very hard for most traders to trade with trading strategies that have such a low win rate. And one of the things that I want you to know is that even though it's kind of like a theory, okay? It's not as if it's been proven to be a universal law or something like that. But most of the times when you're trading with a trading strategy that has a very high reward to risk ratio, for example, like this one, you're risking 5 to make 1%. sorry, you're risking 1% to make 5% on average. What you're going to find is that because most times if you're risking 1 to make 5, let's say the distance between your trade entry and your stop loss is something like 20 pips. This would automatically mean that the distance from your trade entry to your profit target, if you're aiming for 5 times what you're risking, is going to be 100 pips. And so by virtue of this, it's going to be much difficult for price to actually hit your profit target compared to it hitting your stop loss. And this would make it that most of the times the market is going to find it much easier to hit your stop loss than it would find it to hit your profit target. And so when you're trading with strategies that have high reward to risk ratios, their win rate is usually going to be very low. But if you reduce your reward to risk ratio just a little bit, that tends to increase your win rate, slightly increase your win rate. And so if you notice that you're the type of trader who really doesn't like taking losses, no matter how much we sit down and work the numbers and you see firsthand that, there's a way that you can manipulate this so that even if you take 80% losses, just have a 20% win rate, you're still going to end up being profitable. In the heat of the moment, when you're getting bombarded by losses after losses after losses, you don't feel like, trading just gets really stressful. Then you could trade with a lower reward to risk ratio trading strategy, like a 1:2 risk to reward ratio trading strategy. This would only mean that your win rate is not going to be very high and it's not going to be very low, but also the profits you're likely going to make is also going to not be that high as the profits somebody who is trading with a high reward to risk ratio is going to get. So how does that work out? Let's use the same example here. But instead of going with a 1:5 risk to reward ratio, let's use a 1:2 risk to reward ratio and see how much profits you would make with a 30% win rate so that you can see the difference here, okay? And this is not supposed to be minus, this is supposed to be positive because this ended up being profitable, okay? So in this case, you're trading with a 1:2 risk to reward ratio. Now, when you're trading with a 1:2 risk to reward ratio, remember, our win rate is 30%. So 70 of the trades we took were all losses and we're risking 1%. Okay? And 30 trades were all winning trades. But every winning trade we had gave us a profit of 2%. So now we're going to multiply that 2% by the 30 winning trades that we took. So our gross profit is going to end up being 60%. Okay? It's not... Let's tweak the number a little bit so that it will just end up being profitable, because this would still end up being a loss. So let's say 2.5%. 2.5%. What I mean by 2.5 is risk to reward ratio. We're risking 1 to make 2.5. Okay. This is just to illustrate to you that with the same win rate, different traders could have widely different profit outcomes because of their risk to reward ratios and risk management. Okay, so let's say each winning trade gave us a profit of 2.5%. So 2.5% from every winning trade times 30 winning trades that we took. So you'd end up with a profit of, yes, plus 75%. Okay, so in this case, your gross profit is going to be plus 75%. Now, what is your net ROI going to be, or your net profit or ROI is going to be 5%. Why? Because in this case, you're only aiming for a profit of 2.5% when you're risking 1%. So because your win rate is 30% and your risk per trade was only 1%, you can see that when all is said and done, your net profit is only plus 5%. Plus 5%. But for the same trader using the same trading strategy, but trading with a 1:5 risk to reward ratio, you can see he almost doubled his account. So if you want to have a slightly higher win rate, it's possible. If you're trading with a slightly lower reward to risk ratio trading strategy. But know that the profits that somebody is going to make that has a much lower win rate than you, but is going with a higher reward to risk ratio strategy, is going to be much higher than yours. If you've made peace with that and you're okay with that, then go for it. That's why I keep telling you guys this thing. There's no one size fits all trading strategy or approach in trading. You need to find something that works for you, then test it out and find something that you're comfortable with, and then adopt it and stick to it with discipline, religiously. Okay? And so this pretty much brings us to the end of this week's edition of the class, and I sincerely hope you found a lot of value in what we've been able to offer. And before we wrap up the class, I would like to use this opportunity to also invite you guys to test out our trading platforms, our trading suite of trading bots, which are designed to trade on your behalf, basically trade on your behalf. They look for the trade setups for you, place those trade setups with, if you follow our risk recommendations with proper risk management, and they get you earning while you're learning how to trade manually. Okay, so you could allocate a portion of your portfolio to automated trading while you also learn how to trade a portion of your portfolio manually using the classes that we offer in the ITU Forex class. So if this sounds like something you're interested in, please reach out to us on any of our social handles or drop a comment in the comment section and tell us, and we'll be more than happy to assist you set everything up step by step and get you up and running as fast as possible. In the meantime, thank you very much for taking time out of your busy schedule to attend these classes. I sincerely appreciate your time and your enthusiasm to learn and all of that. I look forward to seeing you guys in next week's edition. Have a wonderful rest of your week and go out there and crush the market. Cheers.